This is Audible.
Security Analysis, 7th edition, Principles and Technique. Written by Benjamin Graham, David L. Dodd, and Seth Klarman. Foreword by Warren E. Buffett. Narrated by Scott R. Pollock. Copyrighted by McGraw-Hill, LLC. This audiobook was recorded in arrangement with McGraw-Hill Education and was produced in the year 2023 by Echo Point Books and Media, LLC, which holds the copyright thereto. Many shall be restored that now are fallen, and many shall fall that now are in honor. Horace, Ars Poetica. Foreword by Warren E. Buffett. There are 4 books in my overflowing library that I particularly treasure, each of them written more than 50 years ago. All, though, would still be of enormous value to me if I were to read them today for the first time. Their wisdom endures, though their pages fade. 2 of those books are first editions of The Wealth of Nations, 1776, by Adam Smith, and The Intelligent Investor, 1949, by Benjamin Graham. A third is an original copy of the book you hold in your hands, Graham and Dodd's Security Analysis. I studied from Security Analysis while I was at Columbia University in 1950 and 1951, when I had the extraordinary good luck to have Ben Graham and Dave Dodd as teachers. Together, the book and the men changed my life. On the utilitarian side, what I learned then became the bedrock upon which all of my investment and business decisions have been built. Prior to meeting Ben and Dave, I had long been fascinated by the stock market. Before I bought my first stock at age 11, it took me until then to accumulate the $115 required for the purchase. I had read every book in the Omaha Public Library having to do with the stock market. I found many of them fascinating and all interesting, but none were really useful. My intellectual odyssey ended, however, when I met Ben and Dave, first through their writings and then in person. They laid out a roadmap for investing that I have now been following for 57 years. There's been no reason to look for another. Beyond the ideas Ben and Dave gave me, they showered me with friendship, encouragement, and trust. They cared not a whit for reciprocation. Toward a young student, they simply wanted to extend a one-way street of helpfulness. In the end, that's probably what I admire most about the 2 men. It was ordained at birth that they would be brilliant. They elected to be generous and kind. Misanthropes would have been puzzled by their behavior. Ben and Dave instructed literally thousands of potential competitors, young fellows like me who would buy bargain stocks or engage in arbitrage transactions, directly competing with the Graham-Newman Corporation, which was Ben's investment company. Moreover, Ben and Dave would use current investing examples in the classroom and in their writings, in effect doing our work for us. The way they behaved made as deep an impression on me and many of my classmates as did their ideas. We were being taught not only how to invest wisely, we were also being taught how to live wisely. The copy of Security Analysis that I keep in my library and that I used at Columbia is the 1940 edition. I've read it, I'm sure, at least 4 times, and obviously it is special. But let's get to the 4th book I mentioned, which is even more precious. In 2000, Barbara Dodd Anderson, Dave's only child, gave me her father's copy of the 1934 edition of Security Analysis, inscribed with hundreds of marginal notes. These were inked in by Dave as he prepared for publication of the 1940 revised edition. No gift has meant more to me. Preface to the 7th edition, The Timeless Wisdom of Graham and Dodd, by Seth A. Klarman. The world of investments is one of unlimited choices, significant opportunity and great rewards, as well as shifting landscapes, untold nuances, and serious perils. Against that backdrop, investors must weigh multiple and sometimes competing objectives, generating income, growing principal over time, protecting against loss and the ravages of inflation, and maintaining a degree of liquidity to provide future flexibility and meet unexpected needs. Finding the right balance is essential. To do so, investors need a guidebook that offers them not a plan to succeed in a particular moment, but rather a set of principles to steer them through any and all environments. In 1934, in the depths of the Great Depression, Benjamin Graham and his colleague David Dodd produced such a volume, Security Analysis, detailing how to sort through thousands of different common stocks, preferred issues, and bonds and identify those worthy of investment. Over the ensuing 90 years, during which it has remained consistently in print, Security Analysis has been crowned the Bible of value investing. The stringing together of their very names, Graham and Dodd, has become synonymous with this sensible and timeless approach. The sixth edition of Security Analysis was published in the middle of the worst financial crisis since Graham and Dodd's time. The edition in your hands builds on the sixth and reflects on new events in the markets and the current economic backdrop and business landscape, as well as developments in the field of investment management and security analysis. As with the sixth edition, we have assembled leading practitioners and market observers to update and provide commentary on the content of the book's acclaimed second edition. In our attempt to distill what has changed over the years, we have striven to separate reality and enduring wisdom from what is ephemeral, protean, and illusory. Although markets have evolved enormously in the past 9 decades and the book's historic examples show their age, you will see in the pages that follow that many of the value investing principles at the heart of security analysis are just as applicable today as ever. The heft and detail of security analysis immediately suggests that it is not an easy read. Today's aspiring investors and early career practitioners may wonder whether it's worth the effort. The other contributors and I strongly believe that it would indeed be time well spent. Enduring principles. Change is the one constant in the investment world, and for any investment book to pass the test of time, it must hold universal. A successful investment philosophy, such as value investing, must address the challenges in navigating change, remaining flexible in approach and tactics while grounded in basic, unwavering principles. The alternative, a strategy that blows with the wind, almost ensures being perpetually whipsawed by volatile markets and burdened by frenetic trading. Many of the details in the original security analysis belong to another era. The earliest editions implicitly describe a smokestack economy in which steam-driven locomotives race across the landscape to deliver a cornucopia of manufactured goods. Today, the U.S. and global economies are increasingly characterized by tens of millions of men and women at keyboards and screens, gathering, tracking, and analyzing data for the information economy, while countless others are energetically engaged in the burgeoning service economy. Many of the companies mentioned in the early editions have been merged, restructured, or liquidated out of existence, and some of the tools and methods Graham and Dodd used are outmoded or losing relevance. Book value, for example, is far less relevant for investors today than a century ago. Graham and Dodd recommended that investors purchase stocks trading for less than 2/3 of net working capital, defined as working capital less all other liabilities. Many stocks fit this criterion during the Depression years, far fewer do today. Yet while many of Graham's examples and tools have been eclipsed by the passage of time, the general principles of Graham and Dodd still hold true because the investor behaviors that drive markets are fixed in human nature, and market inefficiencies can always be found. Generations of investors have adopted the teachings of this book and successfully implemented them across highly varied market environments, geographies, asset classes, and securities types. This would delight the authors who hoped to set forth principles that would stand the test of the ever-enigmatic future. Graham and Dodd witnessed and wrote about how they navigated through the financial markets of the 1930s, an era of protracted economic depression and extreme risk aversion. The decade that began in the late 1920s encompassed the best and then the worst of times in the markets. the euphoric run-up to the 1929 peak, the October 1929 crash, and the relentless grinding down of the Depression years. Though distant from today, exploring such a period remains valuable. After all, each new day has the potential to throw a curveball. A war, a pandemic, a macroeconomic shock, a real estate crash, a financial crisis, the unexpected failure of a prominent company, a sovereign default, a broad-based technological upheaval, or dramatic political or regulatory change. People tend to assume that tomorrow will look very much like today, and most of the time it does. But every once in a while, conditions change abruptly and conventional wisdom is turned on its head. In those times, many investors don't know what to do and may become paralyzed. They need a guiding philosophy, and Graham and Dodd offer an excellent one. "We have striven throughout," they write, "to guard the student against overemphasis upon the superficial and the temporary, which is at once the delusion and the nemesis of the world of finance. It is during periods of tumult and upheaval that a value investing philosophy is especially beneficial." Fluctuating share prices are a major driver of opportunity. Graham and Dodd remind us that stocks represent fractional ownership interests in a business, and bonds are senior claims on that business. The most important element of an investor's return from an equity investment is the cash flows generated by the underlying business itself. When McDonald's sells billions of hamburgers, the owner of 1% of the company's shares sells tens of millions. The value of every business is thus inexorably related to its current and future financial performance. In valuing businesses, markets will often be inefficient, causing securities prices to under or overshoot. Emotional overreactions can, for a time, overpower fundamentals. When prices overshoot, euphoria is eventually overtaken by reality, causing them to retrench. When they undershoot, investors can take advantage of such mispricings to pick up a fractional interest in a business at bargain levels. Over the long run, as current uncertainties and temporary business difficulties are resolved, share prices tend to gravitate toward the value of the underlying businesses, and bargain-hunting value investors enjoy a profit. Share prices, in themselves, hold no particular informational value. Day to day, they are set by the forces of supply and demand, and driven more by the whims, beliefs, and exigencies of other buyers and sellers than by a measured, rational assessment of business performance and prospects. Unexpected developments, heightened uncertainty, and moment-by-moment capital flows exacerbate short-term market volatility, and prices sometimes depart from a company's underlying value. Small changes in assumptions or sentiment can cause wild price swings, as can be observed from the prices of the shares of scores of fast-growing but still unprofitable technology and biotech companies in recent years. These fluctuations give rise to one of the greatest challenges of investing. While an analysis of a company and its value can be spot on, the stock market can fail to reward that insight and can even appear to refute it. Indeed, an investor may not be rewarded for quite some time and perhaps experience sizable paper losses. Investors, therefore, can be right, yet appear wrong to themselves and to anyone who looks. While at first blush this may seem to be a problem, it is actually an opportunity. Graham and Dodd's philosophy maintains that the financial markets themselves are the ultimate creator of opportunity. On any given day, some securities may be priced more or less correctly, others not. But in the long run, fundamentals are what drive business value. Graham is credited with explaining, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." By acknowledging and taking advantage of this dichotomy, investors can profit from bargains as they patiently wait for the underlying fundamental value of a business to be reflected in its share price. Those who are able to develop reliable investment convictions about the securities in which they plan to invest and can tolerate significant market fluctuations and potential drawdowns will benefit when the undervaluation they perceive becomes even more egregious as long as they have the fortitude to hang on and ideally add to their holdings. Somewhat counterintuitively, extreme undervaluation can serve as its own catalyst, attracting not only bargain hunters in the public markets, but also opportunistic buyers of the whole business. Just as market fluctuations can appear to refute accurate analysis, prices may temporarily seem to validate incorrect conclusions. Investors who gain confidence from rising market prices, for example, may make the mistake of gaining additional conviction in their investments at the very moment when they are, in fact, becoming less and less attractive. Learning to love markdowns is critical for long-term investment success. Key is the ability to retain the perspective that markdowns represent the opportunity to buy an additional stake in a business at an even better price, and that a markdown is a loss only if you sell. From this vantage point, what seems on the surface like bad news is actually a positive development. Obviously, in the face of a downdraft, it is incumbent on investors to regularly check their analysis and reaffirm their conclusions, especially in the face of sudden and surprising price declines, to assess whether the price action may reflect important information, either of new developments or information that your own analysis may have missed or misunderstood. Investors who lack confidence and staying power, or who are under onerous short-term performance pressures, are prone to bailing out when the prices of what they own move lower. Investors must be resolute in the face of withering criticism from clients and superiors and their own self-doubt during protracted periods of underperformance. That's why, for those managing other people's money, having patient, long-term oriented clients is crucial. At the other end of the spectrum, investors who are overly confident are prone to confirmation bias, meaning that they exult over the elements that confirm their thesis while filtering out or looking past anything that may tend to disprove it. Investors must do the work to develop conviction regarding an investment thesis, checking and rechecking their analysis before they act. At the same time, they must remain open to updated information and new perspectives, and thus to changing their minds as warranted and without bias. They must walk a tightrope of developing strong convictions but holding them lightly. It is also important to recognize that while the outcomes of investments are determined by the fundamentals of the underlying businesses in which you invest, the returns are inextricably linked to the purchase price. The less you pay relative to underlying value, the higher your investment returns will be. Discipline matters in both buying and selling. In the words of Graham and Dodd, the price of a security is frequently an essential element, so that a stock may have investment merit at one price level but not at another. The old adage sums it up. Price may be what you pay, but value is what you get. At the core of value investing, buying a dollar at a discount. Value investing, whether in Graham and Dodd's day or ours, is the practice of purchasing securities or assets for less than they are worth, buying the proverbial dollar for 50 cents. Value investors can profit two ways, both from the cash flows generated by the underlying business and from a capital gain when the market better recognizes the underlying value and reprices the security. They also benefit from an important margin of safety conferred by the bargain purchase. A margin of safety provides room for error, imprecision, bad luck, or the vicissitudes of the economy and stock market. It offers a degree of downside protection. While some might mistakenly consider value investing a mechanical tool for identifying statistical bargains, that is, stocks whose price-to-book or price-to-earnings ratio falls below a certain level, it is, in actuality, a comprehensive investment philosophy based on performing in-depth fundamental analysis, pursuing long-term investment results, resisting crowd psychology, and limiting risk. Identifying and buying bargains is the sweet spot of value investors. But how much of a bargain to require in order to buy or continue to hold is a matter of art and not science, a judgment call. Price targets for buying and selling must be set and then regularly adjusted to reflect all currently available information. Value investors should plan to completely exit a security by the time it reaches its full value. Owning overvalued securities and hoping they appreciate further is a game for speculators. Indeed, value investors should typically begin selling at a 10% to 20% discount to their assessment of a security's underlying value. The exact discount based on the liquidity of the security, the possible presence of a catalyst for value realization, the quality of management, the degree of leverage employed by the business, and their own confidence regarding the assumptions underlying their analysis. Exiting an investment too early and leaving money on the table may be frustrating, but it is far less painful than attempting to get out after it's too late. Round-tripping an investment, watching it go up, failing to sell it, and watching it go back down can be psychologically unsettling and economically costly. Disciplined selling, on the other hand, can open opportunities to exit your position and then possibly reinvest back into a company you already know well at an improved price. One might think of value investing as the marriage of a contrarian streak and a calculator, the mixing of deep, fundamental analysis with a propensity for going against the grain. Having a differentiated viewpoint is essential. In the stock market, good news isn't helpful if it's already baked into investor expectations. Drivers of financial market inefficiency. What drives financial market inefficiency? Investors, being human, sometimes buy or sell for emotionally charged reasons such as exuberance or panic. They periodically alter their decision-making, not in response to investment fundamentals, but to recent performance that significantly expanded or shrank their own net worth. They might not want to miss out on a trend their peers have been profiting from. They can be lulled into complacency and even risk-seeking behavior by the momentum of the market. They might find it hard to maintain a contrarian view that has, so far, been costly. They might also overreact to surprises, particularly a quarterly earnings shortfall or an unexpected credit rating downgrade. They may be overwhelmed by the analytical challenges involved with rapid corporate change, complexity, or heightened uncertainty. Investors always need to fight the tendencies to warm to investments whose price has been rising and bail on those whose price has been falling. Security prices deviate from fundamental value for myriad other reasons as well. One is that investors may well have very different visions of reality. Some are inveterate optimists, while others are pessimists. Some become cheerleaders for their holdings, falling in love with their hypotheses. Investors' time horizons also differ, as do their expectations for the future. A university endowment or philanthropic foundation may be able to take a truly long-term perspective, but a couple nearing retirement age and expecting to soon begin living on their nest egg cannot. Individual risk tolerances also vary, both for interim price fluctuations, but also, more important, for the prospect of a permanent loss of capital. Income needs from a portfolio differ as well, and some investors may be forced to exit a stock that omits its dividend or a bond that defaults regardless of price. In addition to all these reasons for market inefficiency, people will always be subject to their own behavioral biases, as Daniel Kahneman brilliantly describes in Thinking, Fast and Slow, 2013. People tend to anchor to the price they paid for an investment and then stubbornly hold on to the investment when it runs into trouble, irrationally waiting for it to return to the price they paid for it to get out without a loss when selling might have been the right thing to do. And after a financial loss, people often become more risk-averse, causing them to possibly miss out on the next fat pitch. People tend to overestimate the future likelihood of events that they recently experienced and underrate the possibility of events that haven't lately occurred. The cumulative effect of investors committing many small irrational acts can result in significant mispricings. A major challenge for investors is to be aware of, fight, and overcome their own biases, relying instead on objective realities and truths. This way, they can profit from mispricings rather than contribute to them. Another reason to expect ongoing securities mispricings is that many investors must adhere to institutional constraints that limit their behavior. Such constraints are usually well-intentioned, but they nevertheless detract from market efficiency because they limit the pool of potential buyers and sellers for some securities. Many investment funds, for example, are required by their charters to operate within narrow silos that restrict ownership of investments to those that have an investment-grade credit rating, pay a cash dividend, or are listed on an exchange. Others are restricted to a single industry. But in investing, price is king. Almost any security is a buy at one price, a hold at another, and a sell at yet another. Anything that prevents investors from buying or selling the most compelling opportunities available is a constraint that can lead to inferior performance. So how does a value investor take advantage of, rather than succumb to, all these sources of inefficient and non-economic behavior? At my firm, the Baupost Group, we actively and deliberately seek to create a culture that minimizes the risk of irrational or biased behavior. We work in teams to regularly incorporate fresh information and new perspectives into our analysis and calmly debate our decisions. We also work to ensure that we are not limited by institutional constraints. We search for opportunity by surveying, analyzing, and tracking the securities and assets we believe are most likely to be inefficiently priced. Those are often found in the gaps between traditional investment silos and include newly distressed or downgraded debt instruments, companies undergoing rapid corporate change such as mergers, major asset sales and spin-offs, and situations involving great uncertainty, such as those subject to major litigation. We regularly pull at the threads of one interesting situation to find others. We look for patterns based on past investment successes. We rummage through the list of new lows, knowing that out-of-favor securities can be an attractive source of bargains. We search expansively for potential opportunity and then dig deeply to verify that each situation is truly undervalued. Even after we buy, we keep digging. The art of business valuation. While value investing is about buying into businesses at discounts to their fair value, doing so is by no means a paint-by-numbers exercise. It is not simply the practice of buying securities trading at the lowest multiples of recent earnings, cash flows, or book value. After all, sometimes a stock sports a low valuation multiple for good reason. Troubling trends, competitive challenges, a broken business model, hidden liabilities, protracted and potentially crippling litigation, or incompetent or corrupt management. Investors must consider every potential investment with skepticism and humility, relentlessly hunting for additional information while realizing that they will never know everything about a company. So how exactly do we ascertain value in order to recognize if a bargain is available? There are a number of useful methodologies. Among them, the calculation of the present value of estimated future cash flows, applying sensible multiples of relevant income statement, balance sheet, and cash flow metrics, assessing the private market value of a company, that is, the value a knowledgeable third party would reasonably pay for the business, and establishing the breakup value, that is, the amount to be realized if the various segments of a business were sold separately to the highest bidders. Value cannot usually be captured in a single point estimate, and an investor would be wise to consider all these methodologies to determine a plausible range of value. Each of these methodologies has its strengths and weaknesses. Private market value can fluctuate with the moods of the market and swings of the economy, and sometimes there are few, if any, private bids available for a given asset. Such transactions are also typically dependent on the availability and cost of financing. Applying multiples, on the other hand, has the benefit of relying on observable financial metrics. This approach may be more objective on the surface, but insisting on very low purchase multiples may inadvertently filter for lower quality or deteriorating businesses, or fail to capture the value inherent in rapidly growing subsidies. While Graham considered corporate earnings, dividend payments, and book value to be the most important metrics in analyzing a stock, for example, most value investors today look past those factors to focus on the generation of free cash flow. That is, the cash produced annually from the operations of a business after all capital expenditures are made and changes in working capital are considered. Investors turned to this approach because earnings reported under GAAP can differ materially from the cash actually generated by a business. For example, depreciation and amortization are non-cash charges that alter the reported bottom line and mask actual cash generation. Contrariwise, some business activities gobble up cash but aren't expensed, such as accumulations of potentially obsolete inventories or uncollectible receivables. Taking a multiple of appropriately calculated current cash flows, however, might not capture the crucial element of a business's value. Ultimately, it is the future cash flows of a business that matter. If assessing the drivers of the company's current cash flow is an imperfect art, evaluating the likely path of future cash flows is even more daunting, especially as past may not be prologue. Given the difficulty of such forecasting, Graham and Dodd believed this was an endeavor best avoided. In the preface to the first edition of Security Analysis, the authors said, "Some matters of vital significance, for example, the determination of the future prospects of an enterprise, have received little space because little of definite value can be said on the subject. But in today's investing world, something can and, in fact, must be said about future cash flow. Clearly, a company that generates $1 per share of cash flow today, that is reasonably expected to grow to $2 per share of cash flow 5 years from now, is worth considerably more than one with no growth. The quality and source of these cash flows are also relevant. It matters whether the growth is organic or is expected to come from acquisitions, is steady or cyclical, and whether large capital investments are necessary to achieve it. A further complication is that companies can increase their cash flows in many different ways. They can sell the same volume of goods but at a higher unit price, or sell more goods albeit at the same or an even lower price. They might change their product offerings to sell more of the higher profit margin items, or they may develop an entirely new product line. Cash flow growth from cutting costs has very different ramifications for a company than the growth that occurs from expanding one's customer base. When expenses are trimmed, muscle may be lost as well as fat. Such decisions inevitably also impact customer satisfaction and competitor response. Obviously, some forms of growth are worth more than others. Investors need to dig into the details to understand the true growth characteristics of a business and value them properly. Ultimately, despite Graham and Dodd's understandable reservations about the difficulties of projecting the future, in the context of today's rapid and powerful disruption of existing businesses and the steady formation of promising new ones, it is simply not possible to disregard the trajectory of growth or decline when determining the valuation of a business. Investors using the discounted cash flow method must also choose an appropriate discount rate to apply to a company's cash flows. Valuations can be very sensitive to this subjective variable, especially for high-growth businesses, much of whose expected cash flow generation lies far in the future. To set the proper discount rate, investors must assess the quality, consistency, and riskiness of the company's cash flows. The best businesses usually have such attributes as strong barriers to entry, limited capital requirements, organic growth, repeat customers, significant pricing power, high margins, low risk of technological obsolescence, competitive moats, and thus strong, sustained, and increasing free cash flow. In many cases, the growth of such businesses is interwoven with those of other enterprises so that they become larger and more profitable as other companies execute their plans. The highest quality businesses deserve to have their cash flows discounted at a lower rate than other businesses, conferring a higher valuation multiple. How much higher, however, is a subject of never-ending calibration and debate. In all of these valuation analyses, investors must also attempt to assess the skills, capabilities, priorities, and core values of a company's top management. Talented managers clearly enhance the cash flows and improve the capital allocation decisions of the businesses they lead, but managerial ability can't easily be quantified. As Graham and Dodd noted, objective tests of managerial ability are few and far from scientific. But unmistakably, a management's acumen, integrity, and motivation make a huge difference in shareholder returns. The past actions of any management team, whether in their current or previous roles, are perhaps the most reliable guide to future behavior. Alignment of their incentives with the interests of shareholders is also crucial. In addition to running the business well, managers have many other ways to positively impact investor returns. These include timely share repurchases, prudent use of leverage, and astute acquisitions. Managers who are unwilling to make shareholder-friendly decisions risk their companies turning into value traps. They may be undervalued, but ultimately poor investments, because the assets are likely to remain underutilized and cash flows may be squandered. Such underperforming companies should not necessarily be shunned, however, because those firms often attract activist investors seeking to join the board, change management, improve decision-making, and unlock value. Investors must also decide whether to take the risk of investing, at any price, with management teams who seemingly put their own interests ahead of those of shareholders. While the shares of such companies may sell at a steep discount, the discount may be warranted because the value that belongs to the equity holders today may instead be spirited away or squandered tomorrow. In other words, the actual future cash flow generation cannot be included in a discounted cash flow analysis because those cash flows will never find their way to the investor. Ultimately, valuation is as much an art as it is a science, and judgment is constantly required. An investor's analytical left brain skills must be married to her softer right brain skills so she can add nuance and alternative perspectives to her rigorous analysis. In the end, the most successful value investors bear in mind this inherent imprecision as they combine detailed business research and valuation work with endless discipline and patience, deep curiosity, intellectual honesty, and, optimally, the judgment that comes with years of analytical and investment experience. Navigating the age of big data and technological disruption. In the search for investment opportunity, the financial analysis of businesses and securities has become increasingly sophisticated over the years. Even Benjamin Graham's pencil, one of the sharpest of his era, might not be sharp enough today. Now, anyone on Wall Street can build a detailed financial model of any business, since vast amounts of data can be summoned at little or no cost at the touch of a finger. But since that information is readily available to everyone now, it confers no obvious edge. The advantage comes when an investor has an analytical edge or insight that allows her to draw better conclusions. Benjamin Graham and David Dodd acknowledged that they could not anticipate the multitude of changes that would sweep through the investment world over the ensuing years. Technological advances in particular often have a compounding effect that almost ensures more rapid change. New technologies stand on the shoulders of a long chain of previous breakthroughs. Today, accelerating technological change and the disruption it can wreak are regular features of the investment landscape. The robust venture capital industry nearly guarantees that there will be prolific formation of new businesses and intense competition in many or most industries. Furthermore, the steady pace of corporate mergers and acquisitions is bound to materially alter and even transform large numbers of businesses over very short periods. Investors need an investment approach with principles that are constant and practices that are flexible so they can navigate through change, assessing challenges facing incumbent firms as well as the newly fertile soil that can nourish the rapid growth of extraordinary new ones. What makes a business successful in one era may apply less in another, not because the approach isn't a sound one, but because the environment has radically shifted. Tastes have changed, or the competition has caught up, or even leapt ahead. Graham's world was analog. Today's is almost completely digital. Companies today sell products and utilize technologies that Graham and Dodd could never have envisioned. Many enjoy first-mover advantages, rapid and unprecedented scalability, massive competitive moats, low or zero marginal cost of production, and network effects that make the business more profitable and more formidable the larger it grows. Security analysis offers, of course, no examples of how to value a software developer, internet search engine, or smartphone manufacturer, but its analytical tools will be useful in evaluating almost any company, assess the value of its marketable securities, and determine the presence of a margin of safety. Questions of predictability, persistence, growth, business strategy, liquidity, and risk cut across businesses, markets, nations, and time. Over the past quarter century, the Internet has enabled the formation of an enormous number of businesses that simply were not imaginable before, some of the best in the world. One such example is Google, now Alphabet, which collects and analyzes vast and growing quantities of data that give the company an insurmountable advantage in providing increasingly targeted advertising. This capability has enabled the company to completely disrupt the traditional advertising business, building a deeper and deeper moat. Thanks to the Internet and the burgeoning growth of venture capital, an entrepreneur can now envision a business or even an industry that has never existed before, and he or she can raise venture funding, grow the fledgling enterprise exponentially at little or no cost, and, if executed successfully, create a new market leader. This revolution arrived so rapidly that value investors found themselves in an unfamiliar position. Many apparent bargains, evaluated on the basis of a continuation of historic cash flows, were turning out not to be bargains at all. Many such companies were not sound businesses facing a temporary down cycle as in Graham's day. Rather, they had become endangered by technological disruption from innovations that simultaneously destroyed their incumbent businesses while birthing phenomenal new ones that ate their lunch. Technology, a word not found in the index of the first 4 editions of Security Analysis, has obviously become a predominant force in understanding and conducting business analysis. In short, companies develop and market technology, figure out how to use it to improve their operations, or live in fear of it overtaking them. It's now a fact of life, the 800-pound gorilla in almost every room. Technology unleashes a torrent of change, which means that the cash flows of a business today might tell you little about its future prospects, but it's the future cash flows, as previously discussed, that are the true determinant of value. While Graham was interested in companies that produced consistent earnings, analysis in his day was less sophisticated regarding why some companies' earnings might be more resilient than others. Investors today examine businesses, but also business models to identify the best ones. The bottom line impact of changes in revenues, profit margins, product mix, and other variables is carefully studied by managements and financial analysts alike. Investors know that businesses do not exist in a vacuum. Competitors, suppliers, and customers can greatly influence corporate profitability. They also understand that the rapid pace of innovation means that business circumstances can change quickly. Analysts evaluating fast-growing companies must consider not only the current volume of business, but also the potential demand for that product or service and its total addressable market, TAM, in order to assess for how long a company's growth might persist and when it might taper. Similarly, analysts think about the right to win of a business, the market share it might reasonably compete for, based on its cost structure and product advantages. While assessing future prospects of businesses in newly created industries is always difficult, investors would fall short if they failed to analyze and place a value on likely future growth, or consider when and whether that growth might lead to enhanced profitability and cash flow. In earlier eras, one's best guess of tomorrow's business performance was an extension of today's. But now, because of new technologies spurring astonishing growth in many industries and technological disruptions mortally wounding many incumbent businesses, tomorrow is much less likely to look like today than it was in Graham's time. For some businesses, it will look significantly better, and for many others, much worse. This is an inversion of a core tenet of Graham and Dodd, that one's best guess of tomorrow begins with what you see today or with what you saw recently. Value investors have had to become better business analysts than ever before. Value investors cannot ignore the future. They must assign value to rapid and sustainable growth in cash flows, but with caution. Given all the challenges and nuances to ascertaining future cash flows, there is risk in paying for cash flows that are not demonstrated in current financial performance, but rather lie far off in an imagined future. Graham and Dodd observed that analysis is concerned primarily with values which are supported by the facts and not those which depend largely upon expectations. Strongly preferring the actual to the potential, they regarded the future as a hazard which the analyst's, conclusions must encounter rather than as the source of his vindication. Investors should be especially vigilant to not focus on growth exclusively, as that would increase the risk of overpaying. Again, Graham and Dodd were spot on in warning that, carried to its logical extreme, there is no price too high for a good stock, and that such an issue was equally safe after it had advanced to 200 as it had been at 25. This precise mistake was made when stock prices surged skyward during the Nifty 50 era of the early 1970s, the dot-com bubble of 1999 to 2000, and the low-interest rate post-economic stimulus stock market of 2021. Today, business growth may have become more predictable for some companies. Many firms have built what appear to be better mousetraps, high-quality businesses with distinct capabilities that are speedily increasing their market shares. These businesses seem destined to grow well into the future, and investors who won't pay something for that growth may miss out on owning some of the best businesses in the world. Assessing the moats and scalability of such companies has become just as important in ascertaining value today as the reported book value of a company was in Graham and Dodd's time. My firm's approach to analyzing the value of those businesses we believe are likely to consistently grow involves rigorous fundamental analysis and making conservative projections of future results over the next 2 to 3 years, then comparing the multiple of those cash flows to today's share price. If the multiple of near future earnings is reasonable, that is, significantly less than today's market multiple and no higher than low double digits, then the downside is probably limited even if the rate of growth ultimately slows. Broadly speaking, we aim to earn for all our investments an internal rate of return modeled under conservative assumptions in at least the mid-teens, a level high enough to result in a margin of safety for our capital. Investments with lower prospective returns are not sufficiently mispriced to attract our interest. Maintaining a long-term horizon. The difference between investment and speculation. Far too many people buy stocks wanting to make money quickly, but reliable investment returns cannot be earned this way. Value investing works only when allowed the fullness of time. In the short run, any security can trade at any price. If your goal is to make a quick buck, value investing will hold no interest. Speculators generally regard stocks as blips constantly in motion on an electronic screen, like the ball in a spinning roulette wheel, capable of generating gains for those who guess right. Those minute-by-minute fluctuations may generate excitement, but ultimately they are random walks, unpredictable short-term meanderings. Since speculators foolishly decouple share prices from underlying business realities, they are often drawn to whatever has been going up in price, regardless of the foolishness of the valuation. They regularly mistake luck for skill, pointing to an upward price blip as proof that their gambling is paying off. Speculative approaches, which pay little or no attention to downside risk, are especially popular in rising markets. In heady times, few are sufficiently disciplined to maintain strict standards of valuation and risk aversion, especially at a time when many of those who have abandoned such standards are outpacing the pack and becoming rich. In recent years, some have attempted to expand the definition of an investment to include any asset that has recently appreciated in price, or might soon: art, rare stamps and coins, wine collections, NFTs, non-fungible tokens, and hundreds of alternative cryptocurrencies. Because these items generate no present or future cash flows and have values that depend entirely on buyer whim, they should be regarded as speculations, not investments. Ubiquitous 24/7 365 media coverage of the stock market has reinforced investors' overemphasis on the short term. The cheerleading television pundits exult at rallies and record highs and commiserate over market reversals. Viewers get the impression that up is the only rational market direction and that selling or sitting on the sidelines is not just a poor choice, it may even be unpatriotic. These shows promote a herd-like mentality, blurring the lines between investing and speculation. Financial cable channels also create the false perception that one can reasonably formulate an opinion on everything pertinent to the financial markets. We live in a soundbite culture that peddles the idea that investing is not painstaking or rigorous, but easy. There will never be a Graham and Dodd channel on cable business TV. Human nature ensures it. That channel would be the broadcasting equivalent of watching paint dry. Then there is the influence of social media. In recent years, speculators gathering on Reddit and other such platforms have gained notoriety for their involvement in meme stocks, typically frail and even near bankrupt companies that are often being sold short by hedge funds. This herd regards the stocks as speculative vehicles and treats them like a casino game. While occasionally their bull raids squeeze a short seller overexposed to a single name, the combination of poor fundamentals and overvaluation is toxic and can be expected to sink most meme stocks over time. When you overpay and ignore fundamental value, you've almost certainly locked in future losses. You simply don't realize it yet. Value investing is a risk-averse approach. The proper goal of a long-term investor is not to make as much money as possible as quickly as possible. It's to earn good, sustainable returns and hang on to them. It's also to increase one's purchasing power over time, after taking inflation into account. Equities are able to support this objective in a way that most fixed income investments cannot. Unlike speculators and their preoccupation with quick gain, value investors strive to limit or avoid loss and thereby mitigate risk. When buying at a bargain price, one's downside is, by definition, truncated. Should the price fall from that level, assuming the value hasn't changed, the downside is further diminished, and the upside greater still. Contrary to academic theory, when a bargain becomes an even better bargain, you have both less risk and higher prospective return. What's key is having long-term capital that makes it possible to hold this perspective and benefit from it. A risk-averse investor is one for whom the perceived benefit of any gain is less than the perceived cost of an equivalent loss. Imagine how you would respond to the proposition of a coin flip that would either double your net worth or extinguish it. Most would respectfully decline to play. Such risk aversion is deeply ingrained in human nature. Yet many unwittingly set aside their risk aversion when the sirens of stock market speculation call. The best way to guard against loss is to conduct deep and rigorous fundamental research. When a small slice of a business is offered through the stock market at a bargain price, it is helpful to evaluate it as if the whole business were being offered for sale there. This analytical anchor helps value investors remain focused on the pursuit of long-term results rather than the profitability of their daily trading ledger. Defining and managing risk. Many academics and professional investors define risk in terms of the Greek letter beta, which they use as a measure of past share price volatility, meaning that a stock with a relative volatility that has been greater than the overall market's is seen as riskier than one whose volatility has been lower. From this perspective, the greater the risk, the greater the return. But value investors who are inclined to think about risk differently, as the probability and amount of potential loss, find such reasoning absurd. A volatile stock can become particularly undervalued. In fact, and at a reduced price, it may become a very low-risk investment. In the gravity-defying market environment that followed the 2008 to 2009 financial crisis, the most speculative investments regularly performed the best, and many institutional investors came to act as if return achieved is always commensurate with risk incurred. Specifically, they have made the decision to deliberately bear more risk to earn incremental return. But from a value investing perspective, returns come from avoiding risk. When you take on additional risk, you always get the risk, but you may or may not achieve the return. Remember the carnage that comes when market bubbles burst. Stocks that investors eagerly bought at elevated prices based on overly optimistic assumptions find trouble attracting bids at much lower prices, even though at such levels the prospective returns could now outweigh the risks. Risk must also be considered over a period of time. Any security, as mentioned, can trade at any price at a particular moment, but its value is ultimately tethered to the value of the underlying business. Short-term volatility can drive markdowns in the value of one's portfolio, a negative if you're forced to sell and a positive if you can buy more. Longer term, the only risks that really matter are being overly optimistic on corporate cash flows or choosing an inadequate discount rate. The risks of investing in securities are closely related to those of the underlying businesses. Some businesses are more secure in their market positions than others. A low-cost competitor with high profit margins may have a considerable advantage, for example, and a high-cost incumbent a dangerous disadvantage. Some companies are domiciled in unpredictable or unreliable locales, and investing in them may be overly risky. Some companies carry excessive leverage, while others have fortress-like balance sheets that can withstand just about any adversity. Every investor needs to establish her own willingness to incur such risks and determine how much expected return she will require to be paid for bearing them. One of the most difficult questions for value investors is position sizing and its impact on portfolio diversification and risk. How much can you comfortably own of even the most attractive opportunities? I believe value investors should pack their portfolios with their best ideas. If you can tell the good from the bad, you should be able to distinguish the great from the good. However, one reasonable constraint on bulking up on individual holdings and creating a concentrated portfolio is the accompanying loss of liquidity. It's easier to sell stock representing 1% of a company than 5 or 10%. Investors should have a particularly strong conviction before amassing a highly concentrated position, as it will be much harder to exit. Another risk consideration for value investors, as with all investors, is whether to utilize leverage. While some hedge funds and even endowments use leverage to enhance their returns, I side with those who prefer not to incur the added risks of margin debt. While leverage enhances the returns of successful investments, it magnifies the losses of unsuccessful ones. More important, non-recourse, that is, margin debt, raises risk to unacceptable levels because it jeopardizes one's staying power. Value investors should know that even if they are right in the long run, in the short run, a security can trade at any price, and holders need to have sufficiently strong footing to weather the worst of the storm. Otherwise, they may have to liquidate their position at a point of maximum loss well before their insights can be rewarded. One risk-related consideration should be paramount above all others: the ability to sleep well at night, confident that your financial position is secure whatever the future may bring. The academic view. Although value investing has been a successful discipline for generations, one group largely ignores or dismisses it: academics. There's an old joke about the economist who came across a $20 bill on the sidewalk but didn't bother to pick it up, because if it were real, someone else would have already grabbed it. Value investors are always on the hunt for that proverbial $20 bill, skeptical about its existence, but ready to pounce when it's found. With elegant theories that purport to explain the real world, academics sometimes oversimplify and in so doing misunderstand it, because they rely on questionable assumptions regarding the existence of continuous markets, the presence of rational actors, the availability of perfect information, and zero transaction costs. One such theory, the efficient market hypothesis, holds that security prices are always efficient, reflecting all available information about that security, an idea deeply at odds with Graham and Dodd's notion that there is great value in fundamental security analysis. Another academic concept, the capital asset pricing model, relates risk to return, but it always conflates market-correlated volatility, or beta, with risk. Modern portfolio theory applauds the benefits of diversification in constructing an optimal portfolio, but by insisting that once a portfolio is fully diversified, higher expected return comes only with greater risk. MPT effectively repudiates value investing as a viable investment philosophy despite its long-term record of risk-adjusted investment outperformance. Thanks to these theories becoming academic dogma, generations of students have been taught that security analysis is worthless and that they must prioritize portfolio diversification, allocating capital away from their best ideas, because in efficient markets there can be no good ideas, and spreading it into mediocre or poor ones. The very market inefficiencies that introductory finance textbooks brush away provide the opportunity for value investors to earn outsized returns over time. The importance of process and temperament. A necessary part of investing is being intellectually honest. Sometimes you make money because your investment thesis was correct. Other times you simply get lucky. Just because you made money doesn't mean you made a good investment, and just because you lost money doesn't mean you made a poor investment. In order to be successful over the long run, investors must distinguish skill from luck and learn from successes and failures alike. A sound investment process requires a disciplined approach to analysis and a healthy and informed debate over the merits of every investment. Emotion must be avoided. It's important for investment firms to build an environment where people with diverse perspectives and backgrounds can honestly and respectfully share their views. Decision-making must be examined over time, and post-mortems must be conducted in order to improve future decision-making. The best investors focus on process rather than outcomes because they know that good process eventually leads to better outcomes, while good outcomes are not necessarily reflective of good process and could reflect mere luck, not skill. Investors need a plan that can succeed over a full market cycle, one they can stick to with conviction during the inevitable periods of underperformance. If you could predict the future meanderings of the market, you'd want to be fully invested at the bottom and get out at the top. But because we can't predict the path of share prices, the only way to proceed is to invest with the idea of holding your investments through thick and thin. This means buying investments with good upside potential and limited downside risk. But as Graham and Dodd argued so forcefully, we must remember that conditions will change. It makes little sense, for example, to pivot to a more defensive strategy after the market and economy have cratered, or to adopt a more aggressive strategy after the market has surged. In each case, that horse may well have already left the barn. Living through the Great Depression, Benjamin Graham thought deeply about how to invest in the context of unpredictable and dramatic change. Mired in a downturn that seemed like it might go on forever, Graham nonetheless saw that it was temporary even if he couldn't know how long it would last, what would turn things around, or what might lie ahead. In the 1930s, Graham experienced a period of dramatic economic volatility and deep uncertainty, where the most impactful changes were driven by the vicissitudes of the business cycle. Companies had the capacity to produce goods, but customers had no money. The economy was not actively managed by central bankers the way it is today, and it was thus subject to higher volatility. There was no Fed put to support the stock market through periods of economic tumult. Nevertheless, in an extremely challenging market, Graham and Dodd remained faithful to their principles. They knew that the economy and markets would sometimes go through painful cycles, and they also knew these periods must be endured because neither their beginning nor end could be reliably predicted. They expressed confidence in the darkest days that the economy and stock market would eventually rebound. As they noted, while we were riding, we had to combat a widespread conviction that financial debacle was to be the permanent order. Even if you're fully expecting mean reversion for the economy as a whole, it's hard to maintain that view in the face of painful loss or persistent underperformance. Over time, just as investors must deal with down cycles in which business results deteriorate and undervalued stocks become more deeply undervalued, they must also endure and remain disciplined during protracted up cycles in which bargains are scarce and investment capital seems limitless. Between 2010 and 2021, the financial markets performed exceedingly well by historic standards, rewarding the bulls while making downside protection seem a fool's errand, or at least an unnecessary waste. Fear of missing out, FOMO, replaced the fear of loss. The sole focus of most investors became earning a high return on capital rather than ensuring the return of capital. Capital market manias regularly occur on a grand scale. Japanese stocks in the late 1980s, internet and technology stocks in 1999 to 2000, subprime mortgage lending in 2006, and high-growth, though not yet profitable stocks, fixed income investments, and cryptocurrencies in 2020 and 2021. It's hard to bet against bubbles when you're in one. Even experienced investors can wither under the market's relentless message that they are wrong. The pressure to succumb is enormous. Many investment managers fear they'll lose business if they stand too far apart from the crowd or underperform for very long. FOMO can be a powerful force, but value investors must maintain a contrary stance as others around them lose their heads. These days, value investors must also consider the propensity of the Federal Reserve to intervene in financial markets at the first sign of trouble. Amid severe turbulence, the Fed now typically lowers interest rates to prop up securities prices and restore investor confidence. When the economy slips into a downturn, the Fed quickly moves to buy bonds or cut rates. At such moments, Fed officials are trying to maintain orderly capital markets, but some money managers view Fed intervention as a virtual license to speculate. Aggressive Fed tactics to prop up markets, originally referred to as the Greenspan put and now the Powell put, create a growing moral hazard that encourages speculation while prolonging and even exacerbating overvaluation. While Ben Graham recommended focusing on the bottom-up fundamentals of specific investments and largely ignoring macro factors, the Fed has become the 800-pound gorilla, something that cannot be ignored and a presence that tends to get its own way. In 2022, the Fed has begun to reverse these policies to combat elevated inflation with uncertain longer-term impact. My best advice for readers is to continue to invest bottom up, while avoiding being completely wrong-footed by keeping one eye on the prevailing macro backdrop. To ignore the Fed's presence would be to put oneself fully at the mercy of policymaker overreach or misstep. Most important, value investors must fight the tendency to be lulled into a false sense of security by subdued volatility or elevated valuations that may swiftly reverse, and they must never rely on the Fed to rescue them from the overvalued investments they may make. Value investing in 2022, challenges and opportunities. Deep-pocketed, bargain-seeking competitors are the enemy of superior investment performance. Today's vast pools of capital ensure that few investments are completely orphaned or overlooked. Battalions of analysts, many of whom grew up reading prior editions of this very book, are peering into the nooks and crannies of every financial market. While there are many forces that can propel the prices of securities away from fundamental value, buy-side competition is consistently pushing in the other direction. Even a few competitors bidding for an investment can ruin a good thing. It takes only one aggressive buyer to fully correct a mispricing. Yet the good news for value investors is that even with a large value investing community, there are far more market participants who invest without a long-term value orientation. Most managers concentrate almost single-mindedly on the growth rate of the company's earnings or the momentum of its share price. Meanwhile, vast amounts of capital have been flowing into index funds to save money on fees and transaction costs. Index managers automatically buy the stocks in an index, doing no fundamental analysis to validate the purchases. Of course, with more and more investment capital being indexed, future mispricings may increasingly linger and the incremental returns achievable through fundamental analysis could start to rise. In the parlance of Wall Street strategists, value underperformed growth for over a decade after the 2008-2009 financial crisis by nearly unprecedented margins. I set value and growth in quotation marks because these labels can be very misleading. Any stock, growing or not, can be under or overvalued. Academics and Wall Streeters often use these labels as shorthand to identify the half of the market with the lowest multiples as value and the higher multiple half as growth, but that categorization is arbitrary. At times, well over half of the stocks in the market can be undervalued, and at other times, bargains can be quite scarce. This means that one reason for the periodic poor performance of value stocks comes from misunderstanding over a mere label. Those who define value investing as the purchase of the statistically lowest multiple stocks, as measured by price to earnings, price to cash flow, price to book value, etc., are making a serious error. As discussed, the rapid and well-funded innovation we observe every day has accelerated the demise of many old economy businesses. The stock market is hardly unaware of this. The obvious losers in this creative destruction fall in price to a low multiple of yesterday's results. But in a great many cases, this does not make them bargains. Many declining businesses are eroding faster than ever now. They are not value investments and should generally be avoided, except when the market has significantly overreacted and the situation can be assessed to be not as dire as commonly perceived. The poor relative performance of value strategies in recent years has driven many investors to use other strategies, most prominently a growth approach. For many, there has been no price too high to pay for a rapidly growing and promising business. 13 years after the great financial crisis, more than a decade of meager interest rates had driven investors, even conservative ones, into larger and larger equity allocations. TINA, there is no alternative, thinking, drove them out of low-yielding bonds and into stocks, and for many endowments and pension funds, into illiquid and often risky alternative investments such as private equity and venture capital. This led to sizable excesses in the valuation of rapidly growing but still unprofitable businesses, many of which were not expected to produce their first profits or positive cash flows for years. Many slower-growing companies, in contrast, significantly lagged the market indices, trading at levels where they had become quite undervalued compared, for example, to what a private buyer might pay for them. The shares of these more staid companies have often failed to attract large numbers of buyers in this market environment because the disappointing performance of value strategies drove capital flows instead into growth. The thinking was circular. Put more money into what has worked, regardless of price, and avoid what hasn't worked, also regardless of price. This drives up the price of what has worked while reducing the price of what hasn't. This may seem like value hell, but it is actually driving prices in the direction of value heaven, meaning exactly the sort of environment that Graham wrote about. A market in which undervalued companies were as unloved as overvalued companies were adored. One in which bargains became plentiful. Value investors can build edge by taking a view that is longer term than their competitors. Because of the short-term relative performance orientation of most investors and the constant performance comparisons they are subjected to, they can find it hard to look past a valley to imagine the next peak. Not many want to buy a stock if the next few quarters look disappointing, since stocks that fail to beat Wall Street's quarterly estimates are regularly thrashed. Even when short-term negatives have been more than fully baked into share prices, many hold back, waiting for obvious evidence of turnaround or recovery. In effect, they'd rather pay a higher price when the road ahead seems clear, even though by the time everyone can see what they see, the moment of greatest opportunity will have passed. The pressures placed on professional investment managers cause them to act based on non-fundamental considerations. For example, many professional investors engage in certain career management techniques, such as window dressing their portfolios at the end of calendar quarters by selling off losers, even if they are undervalued, while buying more of the winners, even if overvalued. This is because it's hard to keep defending a money-losing investment to disgruntled clients. Being second-guessed is a common professional hazard. Of course, for truly long-term oriented value investors, it's a wonderful thing that many potential competitors are thrown off course by constraints or behaviors that render them unable or unwilling to hold the very best investments. Opportunity is often found where you least expect it, where you have never found it before, and where you have never even looked. During the great financial crisis of 2008, one area of opportunity for my firm and for other value investors ended up being in residential mortgage-backed securities, RMBS, that fell under a dark cloud when the housing market collapsed. These securities, backed by slicing and dicing the cash flows from large pools of residential mortgages, were a Wall Street innovation that, like many, had not been stress-tested. Ratings downgrades caused the entire securitization market to shudder, and holders regurgitated enormous volumes of these suddenly disgraced issues. These now toxic assets plunged when it became apparent that investors would not recover par value. Prices began to discount a further plunge in housing prices, one which could have massively overshot fundamentals. Huge volumes of deeply discounted RMBS were available, offering a very attractive upside with quite limited downside. This example highlights that the bigger the mess, the better the value opportunity that may emerge. Today's value investors also regularly find opportunity in the stocks and bonds of companies stigmatized on Wall Street because of their involvement in protracted litigation, accounting irregularities, financial distress, or scandals. These securities sometimes trade at bargain levels where they become attractive to those who can remain stalwart in the face of bad news. For example, the debt of Steinhoff, a South African company with a large portfolio of European and South African retail businesses, came under tremendous selling pressure after a large accounting fraud was uncovered in December 2017, driving the bonds to a steep discount. But those intrepid enough to sleuth through the limited information available were able to bracket the extent of the fraud and find comfort that the pricing far more than discounted the fraud's extent. In general, for a value investor, companies that disappoint or surprise with lower than expected results, sudden management changes, accounting problems, or ratings downgrades are more likely to be sources of opportunity than the consistently strong performers are. If there are no immediately compelling opportunities at hand, value investors should choose to wait rather than overpay, holding some cash in reserve. Compromising one's standards can lead to disaster. At various times in his career, including in his 2021 Berkshire Hathaway shareholder letter, Warren Buffett has stated that he has more cash to invest than he has good investments. As all value investors must do from time to time, Buffett exercises patience. While waiting, value investors should keep digging to identify new mispricings, uncover incremental kernels of information, and develop fresh insights. New opportunities will inevitably emerge. Importantly, value investors don't need the entire market to be bargain priced. Just 20 or 25 unrelated investments, a number sufficient for diversification of risk. The burgeoning growth of institutional investing and alternative investment vehicles. One of the most important changes in the investment landscape over the past 9 decades has been the ascendance of institutional investing. In the 1930s, individual investors dominated the stock market. In the 1950s, Keith Funston, then the president of the New York Stock Exchange, exhorted the public to own your share of American business. But even as this message was being broadcast, pension funds and other institutions were amassing vast amounts of capital. Together with endowments and foundations, insurance companies, and sovereign wealth funds, as well as mutual funds and other commingled funds for individuals, these institutions came to dominate both the trading and ownership of publicly traded securities. The advent of these large, professionally managed pools of capital have not brought a longer-term orientation to the financial markets. Institutional managers find it hard to have such an outlook when their committees and external consultants keep making increasingly short-term performance comparisons. Constant performance assessment inevitably leads to relative performance comparisons. As with animals in the wild, in investment management, wandering from the herd is risky, subjecting managers to possible relative underperformance and client termination. While the only way to outperform the herd is to be different, only a few investors can weather the inevitable periods of relative underperformance. A second major development in the world of institutional investing has been the rise of so-called alternative investments, a catch-all category that includes venture capital, leveraged buyouts, private equity and private credit, as well as hedge funds. As the 21st century unfolded, they became all the rage among endowments, foundations, and pension and sovereign funds. Thinking that traditional equity and debt markets are too expensive to provide adequate returns and increasingly too efficiently priced to possibly produce alpha, market outperformance, institutional investors have been allocating a growing portion of their assets under management to alternatives. In his 2000 book, Pioneering Portfolio Management, the groundbreaking head of Yale's investment office, the late David Swensen, makes a strong case for these investments. He points to the historically inefficient pricing of many asset classes, the record-high risk-adjusted returns of many alternative managers, the high dispersion between the best such managers and the rest of the pack, and the limited performance correlation between alternatives and other asset classes. He highlights the importance of choosing the right alternative managers by noting the large dispersion of returns between top quartile and third quartile performers. Many endowment managers have emulated Swensen by committing to these asset classes. One of the most popular alternative asset classes today is private equity, a topic Graham and Dodd did not specifically address. Though investing in private businesses may seem quite different from buying fractional interests in publicly traded companies, many of the analytical considerations regarding how each are valued are the same. The precise factors that can cause a stock to become mispriced obviously don't apply in private investments that don't trade on a market, but private investments can become mispriced for similar reasons. Under urgent circumstances, a private company may be sold at a bargain price or accept a capital injection on favorable terms to the investor. They may suffer from a dysfunctional ownership group or poor management. While their holdings are illiquid, private equity investors gain a lever of corporate control to help drive business success and favorable investment outcomes. Control enables an investor not only to benefit from a disciplined approach, a bargain purchase, and timely buy and sell decisions, but also to enact more far-reaching measures, such as returning excess capital to the equity owners, changing a business plan, accelerating capital expenditures, making accretive acquisitions, exiting business units, and even selling the entire company. Similarly, Graham and Dodd never addressed how to analyze direct investments in real estate, buildings of various use as well as land, a vast asset class that has become more popular with institutions. But there are bargains to be had in real estate too, and they happen for all the same reasons. For example, the seller has an urgent need for cash, an inability to perform proper analysis, differences in investor outlooks and time horizons, or investor disfavor or neglect. In a difficult real estate climate, tighter lending standards can constrain would-be buyers and cause even healthy properties to sell at distressed prices. Every building and every parcel of land can be seen as a candidate for investment. Each holds the possibility of being mispriced. And as with private equity ownership, the owner of a building or land parcel has a nearly endless array of options: build or not, determine rents, refurbish or repurpose the building, finance or refinance, or exit. Graham and Dodd's principles, such as the stability of cash flows, sufficiency of return, analysis of downside risk, debt coverage ratios, and contingency analysis of what can go wrong, allow investors to identify real estate investments with a margin of safety in any market environment. Graham and Dodd would have had trouble embracing one type of alternative investment, venture capital, because they would be unlikely to find a margin of safety in it. While there is often the prospect of enormous upside in such an investment, there is also a very high risk of failure. Nor is it clear how to evaluate fledgling enterprises to see if the potential return justifies the risk. Naturally, investors with considerable risk tolerance and sophistication will want to participate in the businesses of tomorrow and to buy in before they come public at what are generally particularly lofty valuations, by allocating a limited portion of capital to this sector while expecting a very bumpy ride. But investors should take note that the venture capital returns of 2020 to 2021 are virtually unprecedented and have benefited greatly from exuberant public market valuations. Further, capital inflows have caused deal pricing at every stage of venture investing to be bid up considerably, increasing the probability that future returns will be lower. These accelerating flows of capital into early-stage companies increases the likelihood that these nascent businesses may face intensified competition in the future. It's unclear whether the businesses enabled by ongoing technological advances can withstand the competitive forces unleashed by the burgeoning volumes of venture capital looking to back their current and future competitors. Hedge funds, another alternative asset class and one with more than $3 trillion of capital under management, are pools of capital that invest in a wide array of instrument and markets and do so in varied ways. They are considered a category mainly because they have a common fee structure that typically pays the manager 1 to 2% of assets under management annually and roughly 20% and sometimes more of any returns generated. These funds had their start in the 1920s. Graham himself ran one of the first. What would Graham and Dodd think about today's hedge funds? I believe they would consider them a mixed bag. Some pursue risk-averse strategies, carefully identifying mispricings and hedging risk. Others pursue short-term profits, employ enormous leverage, or make macroeconomic bets. Still others follow relative performance strategies where they use fundamental investment analysis to buy what they regard as the best companies and sell short the worst companies. When done right, they may earn profits on both sides of the ledger. Illiquidity, lack of transparency, gargantuan size, embedded leverage, and some funds' hefty fees would no doubt raise red flags for Graham and Dodd, but they would probably approve of the hedge funds that practice value-oriented investment selection. While Graham and Dodd emphasized limiting risk on a per-investment basis, they also believed that diversification and hedging could protect the downside of an entire portfolio. Most hedge funds hold some securities that, when considered in isolation, may involve an uncomfortable degree of risk, but they attempt to offset the risk for the portfolio as a whole by employing hedging strategies such as the short sale of similar but higher multiple securities or market indices. Value investing principles are relevant beyond the financial markets. Graham and Dodd's common sense principles apply beyond the financial markets, such as in the search for baseball talent, as eloquently captured in Michael Lewis's 2003 book, Moneyball. The market for baseball players, like the market for stocks and bonds, is inefficient, and for many of the same reasons. In both investing and baseball, there is no single way to ascertain value, no one metric that tells the whole story, and there is voluminous information without a broad consensus on how to assess it. Decision makers in both arenas misinterpret available data, misdirect their analyses, and reach inaccurate conclusions. In baseball, as in securities, executives often face pressures that cause them to overpay for talent because they fear standing apart from the crowd, doing something unpopular, such as failing to re-sign a superstar, and being criticized. They often have an excessively short-term orientation driven by rabid fans, critical media, and impatient owners. They may make decisions for emotional, not rational reasons. They become exuberant. They panic. They fear missing out. They may think they see patterns that aren't really there or don't apply. They fail to understand what is mean reverting and what isn't. Baseball's value investors, like financial market value investors, have achieved significant outperformance over time. Moneyball did not delineate a static approach that would consistently outperform over time. Market inefficiencies in any endeavor attract competition and are often quickly corrected. In response to the dramatic success of early Moneyball adherents, baseball general managers have built sizable teams of data analysts. A key skill set in managing a baseball team, as with investing, is the ability to sort through proliferating masses of data to assign proper weights to disparate factors. There is, in baseball and investing, an endless process of identifying and building edge, and then having those edges whittled down by competition, changes in the market, and sometimes changes in the rules until they are gone. Consequently, new sources of edge must constantly be identified and developed. Baseball general managers have advanced the thinking and science of properly valuing baseball players beyond those represented in Moneyball to measure anything and everything that can be measured. New technologies allow teams to assess a catcher's pitch framing skill as well as the spin rate of pitches and the response time of fielders after the ball has been hit. Just as with investing in the financial markets, the core principles will always apply, but the best applications of those principles will ebb and flow. The fact that Graham and Dodd's principles can help navigate the market for athletic talent attests to the universality and timelessness of their approach. Final thoughts. The essential characteristics of a value investor, patience and discipline, are rare. As Warren Buffett noted in his famous article, The Super Investors of Graham and Doddsville, "It is extraordinary to me that the idea of buying dollar bills for 40 cents takes immediately with people, or it doesn't take at all. It's like an inoculation. If it doesn't grab a person right away, I find you can talk to him for years and show him records, and it doesn't make any difference." My own experience has been exactly the one that Buffett describes. My 1978 summer job and subsequent full-time employment at Mutual Shares, a no-load, value-based mutual fund, set the course for my professional career. The planned liquidation of Telcor and spin-off of its Electro-Rent subsidiary in 1980 forever imprinted in my mind the merit of fundamental investment analysis. A buyer of Telcor stock was effectively creating an investment in the shares of Electro-Rent, a fast-growing equipment rental company, at the giveaway valuation of approximately 1 times cash flow. You always remember your first value investment. If security analysis resonates with you, if you can resist speculating and sit on your hands at times, perhaps you have a disposition toward value investing. If not, at least this book will help you understand where you fit into the investing landscape and gain an appreciation for the value investing community. In a rising market, everyone makes money, and a value philosophy may be unnecessary. But because there is no sure way to predict what the market will do, one needs to follow a value philosophy at all times. Value investors must remain hungry and agile, developing new areas of edge to replace those that are arbitraged away as more investors pile in. They must remain humble, intellectually honest, and deeply curious. They must be responsible stewards of capital, taking into account the influence of their companies on their customers, their communities, and the planet. And they must constantly hone their investment process and develop new insights into human behavior, including their own, while learning from mistakes and successes alike. Finally, they must fight the belief that the way things are today is the way they'll always be. History promises us otherwise. By controlling risk and limiting loss through extensive fundamental analysis, strict discipline, and endless patience, however, value investors can expect good results with limited downside. The real secret to investing is that there is no secret to investing. Every important aspect of value investing has been made available to the public many times over, beginning in 1934 with the first edition of Security Analysis. That so many people fail to follow this timeless approach enables those who adopt it to be successful. I know of no long-time investor who regrets adhering to a value philosophy, and few will ever abandon this time-tested approach for another. Human nature guarantees that the hope for and pursuit of rapid and effortless gain will be with us forever. So as long as others succumb to the siren song of getting rich fast, value investing will remain, as it has been for some 90 years, a sound, low-risk, and successful approach. Truly, the concept of buying securities for less than their worth never grows old. You may not get rich quickly, but you will keep what you have, and if the future of value investing resembles its past, you are likely to get rich slowly. As strategies go, this is the most that any reasonable investor can hope for. Preface to the second edition. The lapse of 6 years since first publication of this work supplies the excuse, if not the necessity, for the present comprehensive revision. Things happen too fast in the economic world to permit authors to rest comfortably for long. The impact of a major war adds special point to our problem. To the extent that we deal with investment policy, we can at best merely hint at the war's significance for the future. As for security analysis proper, the new uncertainties may complicate its subject matter, but they should not alter its foundations or its methods. We have revised our text with a number of objectives in view. There are weaknesses to be corrected and some new judgments to be substituted. Recent developments in the financial sphere are to be taken into account, particularly the effects of regulation by the Securities and Exchange Commission. The persistence of low interest rates justifies a fresh approach to that subject. On the other hand, the reaffirmance of Wall Street's primary reliance on trend impels us to a wider, though not essentially different, critique of this modern philosophy of investment. Although too great insistence on up-to-date examples may prove something of a boomerang, as the years pass swiftly, we have used such new illustrations as would occur to authors writing in 1939 to 1940. But we have felt also that many of the old examples, which challenged the future when first suggested, may now possess some utility as verifiers of the proposed techniques. Thus we have borrowed one of our own ideas and have ventured to view the sequel to all our germane 1934 examples as a laboratory test of practical security analysis. Reference to each such case in the text or in notes may enable the reader to apply certain tests of his own to the pretensions of the securities analyst. The increased size of the book results partly from a larger number of examples, partly from the addition of clarifying material at many points, and perhaps mainly from an expanded treatment of railroad analysis and the addition of much new statistical material bearing on the exhibits of all the industrial companies listed on the New York Stock Exchange. The general arrangement of the work has been retained, although a few who use it as a text have suggested otherwise. We trust, however, that the order of the chapters can be revised in the reading without too much difficulty to convenience those who prefer to start, say, with the theory and practice of common stock analysis. Benjamin Graham and David L. Dodd, New York, New York, May 1940. Preface to the first edition. This book is intended for all those who have a serious interest in security values. It is not addressed to the complete novice, however, for it presupposes some acquaintance with the terminology and the simpler concepts of finance. The scope of the work is wider than its title may suggest. It deals not only with methods of analyzing individual issues, but also with the establishment of general principles of selection and protection of security holdings. Hence, much emphasis has been laid upon distinguishing the investment from the speculative approach, upon setting up sound and workable tests of safety, and upon an understanding of the rights and true interests of investors in senior securities and owners of common stocks. In dividing our space between various topics, the primary but not the exclusive criterion has been that of relative importance. Some matters of vital significance, for example, the determination of the future prospects of an enterprise, have received little space because little of definite value can be said on the subject. Others are glossed over because they are so well understood. Conversely, we have stressed the technique of discovering bargain issues beyond its relative importance in the entire field of investment, because in this activity the talents peculiar to the securities analyst find perhaps their most fruitful expression. In similar fashion, we have accorded quite detailed treatment to the characteristics of privileged senior issues, convertibles, etc., because the attention given to these instruments in standard textbooks is now quite inadequate in view of their extensive development in recent years. Our governing aim, however, has been to make this a critical rather than a descriptive work. We are concerned chiefly with concepts, methods, standards, principles, and above all with logical reasoning. We have stressed theory not for itself alone, but for its value in practice. We have tried to avoid prescribing standards which are too stringent to follow, or technical methods which are more trouble than they are worth. The chief problem of this work has been one of perspective, to blend the divergent experiences of the recent and the remoter past into a synthesis which will stand the test of the ever enigmatic future. While we were writing, we had to combat a widespread conviction that financial debacle was to be the permanent order. As we publish, we already see resurgent the age-old frailty of the investor, that his money burns a hole in his pocket. But it is the conservative investor who will need most of all to be reminded constantly of the lessons of 1931 through 1933 and of previous collapses. For what we shall call fixed value investments can be soundly chosen only if they are approached, in the Spinozan phrase, from the viewpoint of calamity. In dealing with other types of security commitments, we have striven throughout to guard the student against overemphasis upon the superficial and the temporary. 20 years of varied experience in Wall Street have taught the senior author that this overemphasis is at once the delusion and the nemesis of the world of finance. Our sincere thanks are due to the many friends who have encouraged and aided us in the preparation of this work. Benjamin Graham and David L. Dodd, New York, New York, May 1934. Introduction to the 7th edition. Benjamin Graham and Security Analysis, The Historical Backdrop, by James Grant. It will simplify the Führer's whole work immensely if he need not first ask somebody if he may do this or that. The Associated Press quoted a Berlin informant on August 1, 1934, as saying of Adolf Hitler's ascension to the presidency of Germany. Set against such epochal events, a 727-page textbook on the fine points of value investing, the first edition of Security Analysis by Benjamin Graham and David L. Dodd, must have seemed an unlikely candidate for bestsellerdom then or later. In his posthumously published autobiography, The Memoirs of the Dean of Wall Street, Benjamin Graham, 1894 to 1976, thanked his lucky stars that he had entered the investment business in 1914, when stocks, the coming thing, were still a speculative afterthought. The timing seemed not so propitious in 1934. From its 1929 peak to its 1932 trough, the Dow Jones Industrial Average had lost 87% of its value. At cyclical low ebb in 1933, the national unemployment rate had topped 25%. That the Great Depression had ended in 1933 was the considered judgment of the timekeepers of the National Bureau of Economic Research. Millions of Americans, however, not least the relatively few who tried to squeeze a living out of a profitless Wall Street, had reason to doubt it. The bear market and credit liquidation of the early 1930s gave the institutions of American finance a top-to-bottom scourging, and the tag ends that remained came in for rough handling in the first Roosevelt administration. Graham had learned his trade in the era of lightly regulated markets. He began work on security analysis as the Herbert Hoover administration was giving the country its first taste of thoroughgoing federal intervention during a peacetime economy. Graham was correcting page proofs as the Roosevelt administration was implementing its first radical forays into macroeconomic management. By 1934, there were laws to institute federal regulation of the securities markets, federal insurance of bank deposits, and federal price controls, not to put a cap on prices as in later inflationary times, but to put a floor under them. To try to prop up prices, the administration devalued the dollar. It is a testament to the quality of Graham's thought, not to mention the resiliency of America's financial markets, that security analysis gained and held its audience even as the economy was being turned upside down and inside out. 5 full months elapsed following publication of the first edition before Louis Rich got around to reviewing it in the New York Times. Who knows? Maybe the conscientious critic read every page. In any case, Rich gave the book a rave, albeit a slightly rueful one. On the assumption, the critic wrote on December 2, 1934, that despite the debacle of recent history, there are still people left whose money burns a hole in their pockets, it is hoped that they will read this book. It is a full-bodied, mature, meticulous, and wholly meritorious outgrowth of scholarly probing and practical sagacity. Although cast in the form and spirit of a textbook, the presentation is endowed with all the qualities likely to engage the liveliest interest of the layman. How few laymen seemed to care about investing was brought home to Wall Street more forcefully with every passing year of the unprosperous post-crash era. Just when it seemed that trading volume could get no smaller, or New York Stock Exchange seat prices no lower, or equity valuations more absurdly cheap, a new, dispiriting record was set. It required every effort of the editors of the big board's house organ, the Exchange magazine, to keep up a brave face. Must there be an end to progress? Was the inquiring headline over an essay by the Swedish economist Gustav Cassel, published around the time of the release of Graham and Dodd's second edition in 1940. The professor thought not. Why do securities brokers stay in business? The editors posed and helpfully answered. Despite wearying lethargy over long periods, confidence abounds that when the public recognizes fully the value of protective measures which lately have been ranged about market procedure, investment interest in securities will increase. It did not amuse the Exchange that a New York City magistrate, sarcastically addressing a collection of defendants hauled into his court by the police for shooting craps on the sidewalk, had derided the financial profession. The first thing you know, the judge had upbraided the suspects, you'll wind up as stockbrokers in Wall Street with yachts and country homes on Long Island. In ways now difficult to imagine, Murphy's Law was the order of the day. What could go wrong did. Depression was more than a long-lingering state of economic affairs. It had become a world-view. The academic exponents of secular stagnation, notably Alvin Hansen and Joseph Schumpeter, each a Harvard economics professor, predicted a long decline in American population growth. This deceleration, Hansen contended in his 1939 essay, together with the failure of any really important innovations of a magnitude to absorb large capital outlays, weighs very heavily as an explanation for the failure of the recent recovery to reach full employment. Neither Hansen nor his readers had any way of knowing that a baby boom was around the corner. Nothing could have seemed more unlikely to a world preoccupied with a new war in Europe and the evident decline and fall of capitalism. Certainly Hansen's ideas must have struck a chord with the chronically underemployed brokers and traders in lower Manhattan. As a business, the New York Stock Exchange was running at a steady loss. From 1933, the year in which it began to report its financial results, through 1940, the Big Board recorded a profit in only 1 year, 1935, and a nominal one at that. When an assistant professor of economics at Brown University, Chelsea C. Bosland, brought forth a book in 1937 entitled The Common Stock Theory of Investment, he remarked, as if he were repeating a commonplace, that the American economy had peaked 2 decades earlier, at about the time of what was not yet called World War I. The professor added, quoting unnamed authorities, that American population growth could be expected to stop in its tracks by 1975. Small wonder that Graham was to write that the acid test of a bond issuer was its capacity to meet its obligations not in a time of middling prosperity, but in a depression, a test some 20% of today's largest 3,000 publicly traded companies would not come close to passing. Indeed, according to Bloomberg, they failed to cover interest expense from operating cash flow even in the non-depression year of 2022. Altogether, an investor in those days was well advised to keep up his guard. The combination of a record high level for bonds, writes Graham in the 1940 edition, with a history of 2 catastrophic price collapses in the preceding 20 years and a major war in progress is not one to justify airy confidence in the future. Wall Street, not such a big place even during the 1920s boom, got considerably smaller in the subsequent bust. Ben Graham, in conjunction with his partner Jerry Newman, made a very small cog of this low-horsepower machine. The two conducted a specialty investment business at 52 Wall Street. Their strong suits were arbitrage, reorganizations, bankruptcies, and other complex situations. A schematic drawing of the financial district published by Fortune in 1937 made no reference to the Graham-Newman offices. Then again, the partnerships and corporate headquarters that did rate a spot on the Wall Street map were themselves, by the standards of 21st century finance, remarkably compact. 1 floor at 40 Wall Street was enough to contain the entire office of Merrill Lynch and Company, and a single floor at 2 Wall Street was all the space required to house Morgan Stanley, the hands-down leader in 1936 corporate securities underwriting, with originations of all of $195 million. Compensation was in keeping with the slow pace of business, especially at the bottom of the corporate ladder. After a 20% rise in the new federal minimum wage, effective October 1939, brokerage employees were entitled to earn at least 30 cents an hour. In March 1940, the exchange documented the collapse of public participation in the stock market in all the detail its readers could want. In the first 3 decades of the 20th century, the annual volume of trading had almost invariably exceeded the quantity of listed shares outstanding, sometimes by a wide margin. And in only 1 year between 1900 and 1930, had annual volume amounted to less than 50% of listed shares, the exception being 1914, the year in which the exchange was closed for 4.5 months to allow for the shock of the outbreak of World War I to sink in. Then came the 1930s, and the annual turnover as a percentage of listed shares struggled to reach as high as 50%. In 1939, despite a short-lived surge of trading at the outbreak of World War II in Europe, the turnover ratio had fallen to a shockingly low 18.4%. Perhaps, sighed the author of the study, it is a fair statement that if the farming industry showed a similar record, government subsidies would have been voted long ago. Unfortunately for Wall Street, it seems to have too little sponsorship in officialdom. If a reader took hope from the idea that things were so bad that they could hardly get worse, he or she was in for yet another disappointment. The second edition of Security Analysis had been published only months earlier when, on August 19, 1940, the stock exchange volume totaled just 129,650 shares. It was one of the sleepiest sessions since the 49,000 share mark set on August 5, 1916. For the entire 1940 calendar year, volume totaled 207,500,000 599,749 shares. In 2022, a quiet hour's worth of volume, and only 18.5% of the turnover of 1929, that year of seemingly irrecoverable prosperity. The cost of a membership or seat on the stock exchange sank along with turnover and with the major price indexes. At the Nader in 1942, a seat fetched just $17,000. It was the lowest price since 1897 and 97% below the record high price of $625,000 set, naturally, in 1929. The cleaners, quipped Fred Schwed Jr. in his funny and wise book, Where Are the Customers' Yachts?, which, like Graham's second edition, appeared in 1940, was not one of those exclusive clubs. By 1932, everybody who had ever tried speculation had been admitted to membership. And if an investor did somehow manage to avoid the cleaners during the formally designated Great Depression, he or she was by no means home free. In August 1937, the market began a violent sell-off that would carry the averages down by 50% by March 1938. The non-financial portion of the economy fared little better than the financial side. In just 9 months, industrial production fell by 34.5%, a sharper contraction even than that in the Depression of 1920 to 1921, a slump that, for Graham's generation, had seemed to set the standard for the most economic damage in the shortest elapsed time. The Roosevelt administration insisted that the slump of 1937 to 1938 was no depression, but rather a recession. The national unemployment rate in 1938 averaged 18.8%. In April 1937, 4 months before the bottom fell out of the stock market for the second time in 10 years, Robert Lovett, a partner at the investment firm of Brown Brothers, Harriman and Company, served warning to the American public in the pages of the mass circulation Saturday Evening Post. Lovett, a member of the innermost circle of the Wall Street establishment, set out to demonstrate that there is no such thing as financial security, none, at least, to be had in stocks and bonds. The gist of Lovett's argument was that, in capitalism, capital is consumed, and that businesses are just as fragile and mortal as the people who own them. He invited his millions of readers to examine the record as he had done. If an investor had purchased 100 shares of the 20 most popular dividend-paying stocks on December 31, 1901, and held them through 1936, adding, in the meantime, all the melons in the form of stock dividends and all the plums in the form of stock split-ups, and had exercised all the valuable rights to subscribe to additional stock, the aggregate market value of his total holdings on December 31, 1936, would have shown a shrinkage of 39%, as compared with the cost of his original investment. In plain English, the average investor paid $294,911.90 for things worth $180,072.06 on December 31, 1936. That's a big disappearance of dollar value in any language. In the innocent days before the crash, people had blithely spoken of permanent investments. For our part, wrote this partner of the eminent Wall Street private bank, we are convinced that the only permanent investment is one which has become a total and irretrievable loss. Lovett turned out to be a prophet. At the nadir of the 1937 to 1938 bear market, 1 in 5 NYSE-listed industrial companies was valued in the market for less than its net current assets. Subtract from cash and quick assets all liabilities, and the remainder was greater than the company's market value. That is, business value was negative. The great Atlantic and Pacific Tea Company, A&P, the Walmart of its day, was one of these corporate zombies. At the 1938 lows, the market value of the common and preferred shares of A&P, at $126 million, was less than the net value of its cash, inventories, and receivables conservatively valued at $134 million. In the words of Graham and Dodd, the still profitable company was selling for scrap. A different era. Little about today's Wall Street would seem familiar to Benjamin Graham, from the old neighborhood itself, now largely residential, to the immensity of the dollars invested. The depository trust and clearing company processed securities trades in the sum of $2.37 quadrillion in 2021, to the prevalence of index or passive investing. As of March 31st, 2022, index mutual funds claimed $8.53 trillion in assets, compared to $8.34 trillion in actively managed ones. To the advent of commission-free trading, major brokerage houses dropped their rates to zero late in 2019, and the popularity of grading investment securities by the degree of compliance of their corporate issuers with the agenda of the environmental, social, and governance reform movement. Federal securities regulation was a new thing in the 1930s. What had preceded the Securities and Exchange Commission was, at its best, a regime of tribal sanction. Some things were simply beyond the pale. For instance, the solicitation of retail orders for initial public offerings, the risks and rewards of which were reserved for professionals. Both during and immediately after World War I, no self-respecting NYSE member firm would facilitate a client's switch from Liberty bonds into potentially more lucrative, if less patriotic, alternatives. There was no law against soliciting such a swap. Rather, according to Graham, it just wasn't done. A great many things weren't done in the Wall Street of the 1930s. Newly empowered regulators were resistant to financial innovation, transaction costs were high, and technology was, at least by today's digital standards, primitive. After the vicious bear market of 1937 to 1938, not a few investors decided they had had enough. What was the point of it all? In June 1939, approvingly writes Graham in a footnote in the second edition concerning financial innovation, the SEC set a salutary precedent by refusing to authorize the issuance of capital income debentures and the reorganization of the Grease Flagger Tanning Company on the ground that the devising of new types of hybrid issues had gone far enough. Safety is the essence of fixed income investing, according to Graham, who develops the thought in words that continue to be quoted, if not strictly adhered to, today. Thus, our primary conception of the bond as a commitment with limited return leads us to another important viewpoint toward bond investment. Since the chief emphasis must be placed on the avoidance of loss, bond selection is primarily a negative art. It is a process of exclusion and rejection rather than of search and acceptance. One can only speculate how Graham would have adapted this premise to the current era of ultra-low interest rates and to the existence, as recently as year-end 2021, of nearly $18 trillion worth of fixed income securities worldwide, quoted at nominal yields of less than zero. Far from a process of exclusion and rejection, bond investment for the yield-famished savers of today has become a desperate stampede for basis points, a process of inclusion and necessarily uncritical acceptance. Nonetheless, in the 1940 edition, Graham records his support of the system of legal lists, compendia of fixed income securities, authorized by state banking regulators for purchase by the savings banks under their charge. Since the selection of high-grade bonds has been shown to be in good part a process of exclusion, he explains, it lends itself reasonably well to the application of definite rules and standards designed to disqualify unsuitable issues. The 1930s ushered in a revolution in financial disclosure. The new federal securities acts directed investor-owned companies to brief their stockholders once a quarter as well as at year-end. But the new standards were not immediately applicable to all public companies, and more than a few continued doing business the old-fashioned way, with their cards to their vests. One of these informational holdouts was none other than Dun & Bradstreet, D&B, the financial information company. Graham seemed to relish the irony of D&B not revealing its own earnings to its own stockholders. On the whole, by 21st century standards, information in Graham's time was as slow-moving as it was sparse. There were no conference calls, no automated spreadsheets, and no nonstop news from distant markets. Indeed, not much truck with the world outside the 48 states. Security analysis barely acknowledges the existence of foreign markets. Such an institutional setting was hardly conducive to the development of efficient markets, as today's economists style them, markets in which information is disseminated rapidly, human beings process it flawlessly, and price is incorporated instantaneously. Graham, I think, would have scoffed at such an idea. Equally, he would have smiled at the discovery, so late in the evolution of the human species, that there was a place in economics for a subdiscipline called behavioral finance. Security analysis invites the reader to wonder what facet of investing is not behavioral. The stock market, Graham saw 8 decades or so before the arrival of the 2021 meme stocks, is a source of entertainment value as well as investment value. Even when the underlying motive of purchase is mere speculative greed, human nature desires to conceal this unlovely impulse behind a screen of apparent logic and good sense. To adapt the aphorism of Voltaire, it may be said that if there were no such thing as common stock analysis, it would be necessary to counterfeit it. Anomalies of undervaluation and overvaluation, of underdoing it and overdoing it, fill these pages. It bemused Graham, but did not shock him, that so many businesses could be valued in the stock market for less than their net current assets, even during the late 1920s boom, or that, in the dislocations to the bond market immediately following World War I, investors could become disoriented enough to assign a higher price and a lower yield to the Union Pacific First Mortgage 4s than they did to the U.S. Treasury's own Fourth Liberty 4 1/4. Graham writes of the inveterate tendency of the stock market to exaggerate. He would not have exaggerated much if he had written instead, all markets. Though he did not dwell long on the cycles in finance, Graham was certainly aware of them. He could see that ideas, no less than prices and categories of investment assets, had their seasons. The discussion in security analysis of the flameout of the mortgage guarantee business in the early 1930s anticipates the cyclically recurrent race to the bottom in today's equity and credit markets. Graham writes of his time and also of ours. The rise of the newer and more aggressive real estate bond organizations had a most unfortunate effect upon the policies of the older concerns. By force of competition, they were led to relax their standards of making loans. New mortgages were granted on an increasingly liberal basis, and when old mortgages matured, they were frequently renewed in a larger sum. Furthermore, the face amount of the mortgages guaranteed rose to so high a multiple of the capital of the guarantor companies that it should have been obvious that the guarantee would afford only the flimsiest of protection in the event of a general decline in values. Security analysis itself, too, is a cyclical phenomenon, as Graham observed. In season, it holds a strong intuitive appeal for the kind of business person who thinks about stocks the way he or she thinks about his or her own family business. What would such a fount of common sense care about earning momentum or Wall Street's pseudoscientific guesses about the economic future? Such an investor, appraising a common stock, would much rather know what the company behind it is worth. That is, he or she would want to study its balance sheet. Well, Graham relates here, that kind of analysis went out of style when stocks started levitating without reference to anything except hope and prophecy. So, by about 1927, fortune-telling and chart reading had displaced the value discipline by which he and his partner were earning a very good living. It is characteristic of Graham that his critique of the new era method of investing is measured and not derisory. The old conservative approach, his own, had been rather backward-looking, Graham admits. It had laid more emphasis on the past than on the future, on stable earning power rather than tomorrow's earnings prospects. But new technologies, new methods, and new forms of corporate organization had introduced new risks as well as opportunities into the post-World War I economy. This fact, the increasing instability of the typical business, had blown a small hole in the older analytical approach that emphasized stable earnings power over forecast earnings growth. Beyond that mitigating consideration, however, Graham does not go. The new era approach, which turned upon the earnings trend as the sole criterion of value, was certain to end in an appalling debacle, which of course it did, and in the CNBC-driven markets of the 21st century, continues to do at intervals today. A man of many talents. Graham, born Benjamin Grossbaum in London on May 9, 1894, sailed to New York with his family before he was 2. Young Benjamin was a prodigy in mathematics, classical languages, modern languages, expository writing, as readers of this volume will see for themselves, and anything else that the then superb New York City public schools had to offer. He had a tenacious memory and a love of reading, a certain ticket to academic success then and now. His father's death at the age of 35 left him, his 2 brothers, and their mother in the social and financial lurch. Benjamin learned early to work and to do without. No need here for a biographical profile of the principal author of security analysis. Graham's own memoir delightfully covers that ground. Suffice it to say that the high school brainiac entered Columbia College as an alumni scholar in September 1911 at the age of 17. So much material had he already absorbed that he began with a semester's head start, the highest possible advanced standing. He graduated number 2 in the class of 1914 and followed up his Phi Beta Kappa performance by writing a paper suggesting improvements in the teaching of calculus that the American Mathematical Monthly saw fit to publish. From these academic heights, Graham descended to the ground floor of Wall Street, beginning his career as a runner and board boy at the New York Stock Exchange member firm of Neuberger, Henderson, and Loeb. Within a year, the trainee was playing the liquidation of the Guggenheim Exploration Company by astutely going long the shares of Guggenheim and short the stocks of the companies in which Guggenheim had made a minority investment, as his no doubt bemused elders looked on. The profit was realized exactly as calculated, and everyone was happy, not least myself. His masterwork, Security Analysis, did not come out of the blue. Long before he began teaching the Advanced Securities Analysis course at Columbia University in 1928, with the assistance of David Dodd, his future security analysis collaborator, Graham had supplemented his income by contributing articles to the Magazine of Wall Street. His productions are unmistakably those of a self-assured and superbly educated Wall Street moneymaker. There was no need to quote expert opinion. He and the documents he interpreted were all the authority he needed. His favorite topics were the ones that he subsequently developed in the book you hold in your hands. He was partial to the special situations in which Graham Newman was to become so successful. Thus, when a high-flying and highly complex American International Corp fell from the sky in 1920, Graham was able to show that the stock was cheap in relation to the evident value of its portfolio of miscellaneous and not especially well-disclosed investment assets. The shocking insolvency of Goodyear Tire and Rubber attracted his attention in 1921. The downfall of Goodyear is a remarkable incident even in the present plenitude of business disasters, he writes, in a characteristic Graham sentence. How many financial journalists then or later had plenitude on the tips of their tongues? He shrewdly judged that Goodyear would be a survivor. In the summer of 1924, he hit on a theme that would echo through security analysis: the evident non sequitur of stocks valued in the market at less than the liquidating value of the companies that issued them. 8 stock bargains off the beaten track, says the headline over the Benjamin Graham byline. Stocks that are covered chiefly by cash or the equivalent. No bonds or preferred stock ahead of these issues, an unusually interesting group of securities. In one case, that of Tonopah Mining, liquid assets of $4.31 per share towered over a market price of just $1.38 a share. For Graham, an era of sweet reasonableness in investment thinking seemed to end around the time he entered Wall Street. Before, say, 1914, the typical investor was a businessman who analyzed a stock or a bond much as he might a claim on a private business. He would naturally try to determine what the security issuing company owned, free and clear of any encumbrances. If the prospective investment was a bond, and it usually was, the businessman investor would seek assurances that the borrowing company had the financial strength to weather a depression. It's not undue modesty, Graham writes in his memoir, to say that I had become something of a smart cookie in my particular field. His specialty was the carefully analyzed out-of-the-way investment, castaway stocks or bonds, liquidations, bankruptcies, arbitrage. Since at least the early 1920s, Graham had preached the sermon of the margin of safety. As the future is a closed book, he urged in his writings, an investor, as a matter of self-defense against the unknown, should contrive to pay less than intrinsic value. Intrinsic value, as defined in security analysis, is that value which is justified by the facts, for example, the assets, earnings, dividends, definite prospects, as distinct, let us say, from market quotations established by artificial manipulation or distorted by psychological excesses. He himself had gone from the ridiculous to the sublime, and sometimes back again, in the conduct of his own investment career. His quick and easy grasp of mathematics made him a natural arbitrageur. He would sell one stock and simultaneously buy another, or he would buy or sell shares of stock against the convertible bonds of the identical issuing company. So doing, he would lock in a profit that, if not certain, was as close to guaranteed as the vicissitudes of finance allowed. In one instance, in the early 1920s, he exploited an inefficiency in the relationship between DuPont and the then red-hot General Motors. DuPont held a sizable stake in GM, and it was for that interest alone which the market valued the big chemical company. By implication, the rest of the business was worth nothing. To exploit this anomaly, Graham bought shares in DuPont and sold short the hedge-appropriate number of shares in GM. And when the market came to its senses and the price gap between DuPont and GM widened in the expected direction, Graham took his profit. However, Graham, like many other value investors after him, sometimes veered from the austere precepts of safe and cheap investing. A Graham only slightly younger than the master who sold GM and bought DuPont allowed himself to be hoodwinked by the crooked promoter of a company that seems to not actually have existed, at least not in anything like the state of glowing prosperity described by the manager of the pool to which Graham entrusted his money. An electric sign in Columbus Circle on the Upper West Side of Manhattan did bear the name of the object of Graham's misplaced confidence, Savold Tire. But, as the author of Security Analysis confessed in his memoir, that could have been the only tangible marker of the company's existence. Also, as far as I knew, Graham added, nobody complained to the district attorney's office about the promoter's bare-faced theft of the public's money. Certainly, by his own telling, Graham didn't. By 1929, when he was 35, Graham was well on his way to fame and fortune. His wife and he kept a squadron of servants, including, for the first and only time in his life, a manservant for himself. With Jerry Newman, Graham had compiled an investment record so enviable that the great Bernard M. Baruch sought him out. Would Graham wind up his business to manage Baruch's money? I replied, Graham writes, that I was highly flattered, flabbergasted in fact, by his proposal, but I could not end so abruptly the close and highly satisfactory relations I had with my friends and clients. Those relations soon became much less satisfactory. Graham relates that though he was worried at the top of the market, he failed to act on his bearish hunch. The Graham-Newman partnership went into the 1929 break with $2.5 million of capital. They controlled about $2.5 million in hedged positions, stocks owned long offset by stocks sold short and held, besides about $4.5 million in outright long positions. It was bad enough that they were leveraged, as Graham later came to realize. Compounding that tactical error was a deeply rooted conviction that the stocks they owned were cheap enough to withstand any imaginable blow. They came through the crash creditably. Down by only 20% was, for the final quarter of 1929, almost heroic. But they gave up 50% in 1930, 16% in 1931, and 3% in 1932, another relatively excellent showing, for a cumulative loss of 70%. I blamed myself not so much for my failure to protect myself against the disaster I had been predicting, Graham writes, as for having slipped into an extravagant way of life which I hadn't the temperament or capacity to enjoy. I quickly convinced myself that the true key to material happiness lay in a modest standard of living which could be achieved with little difficulty under almost all economic conditions. The margin of safety idea applied to personal finance. It can't be said that the academic world immediately clasped security analysis to its breast as the definitive elucidation of value investing or of anything else. The aforementioned survey of the field, in which Graham and Dodd made their signal contribution, The Common Stock Theory of Investment by Chelsea C. Bosland, published 3 years after the appearance of the first edition of Security Analysis, cited 53 different sources and 43 different authors. Not one of them was named Graham or Dodd. Edgar Lawrence Smith, however, did receive Bosland's full and respectful attention. Smith's Common Stocks as Long-Term Investments, published in 1924, had challenged the long-held view that bonds were innately superior to equities. For one thing, Smith argued, the dollar, even the gold convertible 1924 edition, was inflation-prone, which meant that creditors were inherently disadvantaged. Not so the owners of common stock. If the companies in which they invested earned a profit, and if a portion of that profit were retained in the business, thereby contributing to future earnings, the principal value of an investor's portfolio would tend to increase in accordance with the operation of compound interest. Smith's timing was impeccable. Not a year after he published, the great Coolidge bull market erupted. Common Stocks as Long-Term Investments, only 129 pages long, provided a handy rationale for chasing the market higher. That stocks do, in fact, tend to excel in the long run has entered the canon of American investment thought as a revealed truth, though it looked anything but obvious in the 1930s. For his part, Graham entered a strong dissent to Smith's thesis, or more exactly, its uncritical bullish application. It was one thing to pay 10 times earnings for an equity investment, he notes, quite another to pay 20 to 40 times earnings. Besides, the Smith analysis skirted the important question of what asset values lay behind the stock certificates that people so feverishly and uncritically traded back and forth. Finally, embedded in Smith's argument was the assumption that common stocks could be counted on to deliver in the future what they had done in the past. Graham was not a believer. If Graham was a hard critic, however, he was also a generous one. In 1939, he was given John Burr Williams' The Theory of Investment Value to review for the Journal of Political Economy, no small honor for a Wall Street author practitioner. Williams' thesis was as important as it was concise. The investment value of a common stock is the present value of all future dividends, the author proposed. Armed with that critical knowledge, Williams ventured to hope investors might restrain themselves from bidding stocks back up to the moon again. Graham, in whose capacious brain dwelled the talents both of the quant and of the behavioral financier, voiced his doubts about that forecast. In order to apply Williams' method, he pointed out, one needed to make some very large assumptions about the future course of interest rates, the growth of profit, and the terminal value of the shares when growth stops. One wonders, Graham mused, whether there may not be too great a discrepancy between the necessarily hit or miss character of these assumptions and the highly refined mathematical treatment to which they are subjected. Graham closed his essay on a characteristically friendly note, commending Williams for the refreshing level-headedness of his approach and adding, "This conservatism is not really implicit in the author's formulas, but if the investor can be persuaded by higher algebra to take a sane attitude toward common stock prices, the reviewer will cast a loud vote for higher algebra." Graham's technical accomplishments in securities analysis by themselves could hardly have carried security analysis through its many editions. After all, observes Roger F. Murray, who succeeded Graham as professor of the securities analysis course at Columbia Business School, the Graham and Dodd approach gains and loses adherence with the passing phases of the securities markets. Not all readers of the Reddit message boards during the COVID-era speculative free-for-all found it necessary to familiarize themselves with the concept of a margin of safety. Rather, it's the intelligence, humanity, and good humor of security analysis that, to me, explain the book's long life and the adoring loyalty of Graham's readers. Was there ever a Wall Street moneymaker better steeped than Graham in classical languages and literature and in the financial history of his own time? I would bet no, with all the confidence of a value investor laying down money to buy a bargain. Yet this great investment thinker and doer was, to a degree, a prisoner of his own times. He could see that some of the experiences through which he lived were unique, that the Great Depression was, in fact, a great anomaly. If anyone understood the folly of projecting current experience into the unpredictable future, it was Graham. Yet this investment philosopher king, having spent 727 pages, not including the gold mine of an appendix, describing how a careful and risk-averse investor could prosper in every kind of macroeconomic condition, arrives at a remarkable conclusion. How should he invest? Graham asks, and he answers, at first diffidently, who is he to prescribe for the experienced financiers at the hand of America's philanthropic and educational institutions? But then he takes the astonishing plunge. An institution, Graham writes, that can manage to get along on the low income provided by high-grade fixed-value issues should, in our opinion, confine its holdings to this field. We doubt if the better performance of common stock indexes over past periods will, in itself, warrant the heavy responsibilities and the recurring uncertainties that are inseparable from a common stock investment program. Could the greatest value investor have meant that? Did the man who stuck it out through ruinous losses in the Depression years and went on to thrive in the prosperous post-war era really mean that common stocks were not worth the bother? In 1940, with a new world war fanning the Roosevelt administration's fiscal and monetary policies, high-grade corporate bonds yielded just 2.75%, while blue-chip equities delivered 5.1%. Did Graham mean to say that bonds were a safer proposition than stocks? Well, he did say it. If Homer could nod, so could Graham. And so can the rest of us, whoever we are. Let that, too, be a lesson. Near the close of his memoirs, Graham allows himself to speculate on his legacy. If my name has any chance of being remembered by future generations, assuming that there will be future generations, it will be as inventor of the Commodity Reserve Currency Plan. Graham's plan, intermittently discussed but never implemented, was to iron out the business cycle by directing the U.S. Treasury to stabilize the price level by standing ready to buy and sell a portfolio of 30 basic raw materials at predetermined fixed prices. In effect, the gold standard would become 1/30th of a gold standard, with a potpourri of non-gold materials furnishing the balance of the monetary collateral. The truth is that Graham, amateur playwright, lifetime classicist, a founding spirit of the chartered financial analyst movement, wrote his true legacy in the pages of this durable volume? Certainly, that would be Mr. Market's view. The $20,000 median value of a rare first edition copy represents a nearly 10% per annum rate of return from the original 1934 cover price of $5. And if that achievement falls a little short of the 10.8% compound annual return of the Standard & Poor's 500 over the same interval, with dividends reinvested, a Graham devotee will understand why. The non-taxable dividends that Security Analysis has paid its 4 generations of readers are more precious than the kind that a stockholder gets in the mail. Introduction to the Second Edition. Problems of Investment Policy. Although, strictly speaking, security analysis may be carried on without reference to any definite program or standards of investment, such a specialization of functions would be quite unrealistic. Critical examination of balance sheets and income accounts, comparisons of related or similar issues, studies of the terms and protective covenants behind bonds and preferred stocks, these typical activities of the securities analyst are invariably carried on with some practical idea of purchase or sale in mind, and they must be viewed against a broader background of investment principles, or perhaps of speculative precepts. In this work, we shall not strive for precise demarcation between investment theory and analytical technique, but at times shall combine the two elements in the close relationship that they possess in the world of finance. It seems best, therefore, to preface our exposition with a concise review of the problems of policy that confront the security buyer. Such a discussion must be colored, in part at least, by the conditions prevailing when this chapter was written. But it is hoped that enough allowance will be made for the possibility of change to give our conclusions more than passing interest and value. Indeed, we consider this element of change as a central fact in the financial universe. For a better understanding of this point, we are presenting some data in conspectus form designed to illustrate the reversals and upheavals in values and standards that have developed in the past quarter century. The 3 reference periods, 1911 to 1913, 1923 to 1925, and 1936 to 1938, were selected to represent the nearest approximations to normal or relative stability that could be found at intervals during the past quarter century. Between the first and second triennium, we had the war collapse and hectic prosperity, followed by the post-war hesitation, inflation, and deep depression. Between 1925 and 1936, we had the New Era boom, the Great Collapse and Depression, and a somewhat irregular recovery towards normal. But if we examine the 3-year periods themselves, we cannot fail to be struck by the increasing